Hi, welcome to my channel. My name is Gil Rossi, and today I'm going to share with you my valuation of Tesla. It's going to be again, I think, a long video. I'm going to try to keep it under 1 hour, but there is a lot of things to cover, and I'm going to put stamps so you can jump to the chapter that you like. I encourage you to watch the whole video because I explain why I come with the numbers I'm coming. And I think you will have a better understanding of the company if you do that. But you're free to jump if you want. So let's get to it. Okay, as you know, I always structure my evaluations in two parts. One is the quality of the company, the other one is the quantity. I go through these 4 points when I evaluate the quality: past performance of the company, management, competitive advantages, and financial position. And once these 4 are met, if I feel they are met, I analyze the quantitative issues, which is projections and fair value. Okay, so let's go to past performance. So one just quick thing about the segment information. Tesla has automotive, which includes what we all know, the design and the development manufacturing of vehicles. They also include automotive regulatory credits, which is something that what happens is that they sell credits to other companies that don't meet the regulation. This is mainly in California, and we don't know whether this is going to happen in 10 years when all the companies or most of the companies start selling or producing electric vehicles. It also has other services like insurance and used vehicles and other services like warranty. Here I think in these other services we can include what's going to be software in the future. Could be a big business, especially in full self-drive service, which they are working hard today to accomplish. And then they have the energy generation and storage, which includes design, manufacturing, installation, and leasing of solar energy panels and roofs and all that. So these are the segments and these are the services. They started first with Model S in 2012, which is a high performance model. Then they came with the Model X based on similar body, let's say, but in a SUV form, also a high performance and also high price. Then they came in 2017 with the Model 3, which is more mass market type of car. And based on this Model 3, they made the seven adult seating, 7 adults SUV type in the Model Y in 2020. You can see these are made mainly in Fremont, which is in California, the high performance. And then the 3 and the Y are made also in the Gigafactory for Shanghai. And this is going to be the future, let's say. I mean, the full growth is going to be based on mass market. In the future, they will start with, as we all know, Cybertruck and the Roadster and the Semi. And another vehicle which is going to be full self-driving and is going to be also for mass market appeal and even lower cost. And well, here we have the energy and the solar that we mentioned. Okay, let's go to the full year 2020 and the fourth quarter. Cash flow 2.8 billion, which was quite good, and 1.9 in the last quarter. Here you have the margin 5.4, which is a very, very high margin for especially a company that started to produce at high volume recently. And then here they got to this 5.4 operating margin, even if they had this is a stock-based compensation, went to 1.7 billion. 500,000 vehicles produced. So they are ramping it up fast. You'll see in a minute. Okay, if we go to the first quarter, which they released recently, here we have, while the average sales price declined, still they were able to increase profitability. If you see here, reducing the average cost of the vehicles we produce is essential to our mission. And the cost started to be 84,000 roughly when they started, and now they are in 38,000 roughly in first quarter. So they are reducing the price quite dramatically. So if we go now to last year financial summary, we see sales grew at 46% and the operating margin was also quite substantial. We see here the revenue grew 46%, even though the average sales price declined 11%, because the Model 3 and Model Y are more affordable and they are increasing the production of these, while the Model S and the Model X they are producing it less. So of course the average price is coming down, and this is going to be a theme for the next 10 years. So let's go back here, and you see the operating margin was healthy. They expect operating margin will continue to grow over time. The operating margin is improving. Adjusted EBITDA is quite healthy, I think. The free cash flow also is increasing. So everything looks quite good. Last quarter, a few days ago, the same summary. We have that revenues increased even further, 74 versus 46. And this is, look at these revenues. First quarter, it's normally the lowest in sales. And now they jumped to almost the same as the fourth quarter, which is the highest in sales. So there has been a big jump. I don't know if this is going to be sustainable, if this is going to be sort of like replicated next year in this same pattern, in which case this 10 will be double. So this is going to be 20. I don't know. Operating margin quite healthy as well. If we see, they say that it's also, the level was reached while the stock-based compensation attributable to the CEO, again, 300 million. We're going to talk about the stock-based compensation for the CEO in a minute. Adjusted EBITDA also increased. Free cash flow, positive. More on from last year, this same financial summary, but in terms of in an annual basis, we have 28% growth in revenues, quite substantial. Operating margin, as you can see, improving dramatically, and now it's 6.3%, quite a jump in basis points. EBITDA, 600 basis points increase, and the free cash flow also 258% increase. This is all year from last year, no? But if we see on a compounded annual growth rate from 2016, 46% in total revenues. EBITDA is 62%. Operational summary from last year. I want to show you the growth in total deliveries, 51%. We're planning to grow our manufacturing capacity as quickly as possible. Over a multi-year horizon, we expect to achieve 50% average annual growth in vehicle deliveries. Some years we may go faster, which is going to be the case in 2021. So this is something to keep in mind for my projections. Let's see this same operational summary, but from last quarter, where we can see deliveries ramping up massively, as I discussed this before. And again, they have the same outlook. There's no change from last quarter. Still believing that 50% average annual growth in a multi-year horizon, basically. Okay, so next, supercharger stations growing at 41%. And let me talk a little bit about this. If you see here, gas stations of the future might not include electric vehicle chargers yet. And this is because the economics are not there yet. And the Phillips 66 US chief economist said that they're going to be awfully expensive for the consumer versus charging at home. Because in essence, for Phillips 66 to install these chargers at the 7,000 locations that they have, it will need such an investment that there's not a fleet out there today to keep the chargers running at the rate that would support economically. So what happens here is that it's sort of like a chicken and egg thing. Phillips 66 and probably all the ones that are in the same business don't see the economic motivation to install electric chargers, because of course if you want to install an electric charger in a gas station, you need a fast supercharger, which is at least 30 minutes. And those need high voltage and a higher installation cost. If you do that, you want them to be amortized, the expense, and there's no fleet to use them. So, but the fleet also needs those. So it's a chicken and egg thing, and Tesla is breaking that sort of like chicken and egg thing by making their own supercharging stations, and available for free sometimes, and at a fee, depending on the type of arrangement you make when you buy your car. But this is important. Let's see here another talking also about the chargers. Bloomberg New Energy Finance estimates that 500,000 public chargers would support a fleet of 8.5 million, which is only about half the current fleet projection at 2030. What I want to highlight here is that even with a 500,000 public chargers that the Biden administration is planning to build, it's only going to be enough for half of the projections. So you need other sources of these chargers, and that's why Tesla is also doing that. And this report, Edison Electric Institute, has similar figures. So let's go now to some other things that they show in their presentations, which, by the way, the presentations of Tesla are great from a shareholders or from a potential investor point of view. I think they offer quite a lot of information, and I really like that. It's very clear, full of interesting information. Okay, so this is, for example, one of them. Over the past few weeks, we have been upgrading our Fremont factory to launch the new Model S and Model X. Model X and Model S and X hasn't yet been in production, the new upgraded version. Hopefully next quarter they will be able to start. We also continue to increase Model Y production. So you see here, this is the current capacity that they have in Fremont, in Shanghai. They have a capacity of 250,000 per year for the Model 3, which means 200 for the Model Y. They will ramp up production in 2020, and you see here 450 for the two of them. So they have here almost 1 million in capacity, and they are planning to, I think they are planning to deliver around 750 if they grow at 50%, as they are informing us. Core technology. This is interesting. This is one of the interesting things I like about Tesla. They are CEO is an engineer, and you hear him talking in the earning calls, and he talks about numbers, but the numbers are not with a sign, with a dollar sign in front. They are with a kilowatt hour in front, production and stuff like that. So it's quite interesting to listen. If you see here, I think one of the main advantages that we'll see later, but in one of the advantages that Tesla has is the range. In 2019, they had 44% more range than the highest non-Tesla. Then it jumped to 50 in 2020 and to 52 in 2021. And I think that the gap is widening, because I'm going to show you a couple of clips of them talking in the Battery Day, and it's amazing what they are doing. They are. I don't think that all the other companies are doing what these guys are doing, and I'll talk about this when we go to the advantages of Tesla. But just in case I forget, I'm going to say now that the fact that they can focus all their efforts, all their energy in making the best electric vehicle, the best battery with the highest range, gives them a tremendous advantage to the other manufacturers, because the other manufacturers will have to keep producing ICEs, so internal combustion engines. And they will not be able to put all their efforts in into electric vehicle innovation and electric vehicle technology. And also, if you're an engineer, an electric engineer, and you get offered a job in General Motors to work in the Volt model, or you're offered a job in Tesla to work on the Model X, whatever is going to come in the future. I mean, if you are talented, you're going to go to Tesla. If you're not that talented, you're going to go to GM. So I think that these guys are going to keep widening this advantage. I mean, this is great for the world that we have Tesla really, and that we have someone like Elon Musk. Look at this. The Tesla Model S Plaid. I don't know how they pronounce it. It's apparently another Plaid. I think it's the way that Elon Musk pronounces. It's the fastest car in the world. It's even faster than the Bugatti Chiron. And look, these are the specifications of the Model S. $150,000. It's expensive, but for 200 miles per hour and this power, and as we saw, under 2 seconds of here, under 2 seconds of 0 to 60 miles per hour and 400 miles of range is amazing. Okay, this is the Bugatti Chiron. Of course, it's beautiful. I don't think they can compete with this, but they can compete in price at least. 3 million a pop. Okay, so here we have fourth quarter, some key metrics that I'd like to show you. I'm not going to pay attention to net income because you can manipulate it quite easily, and I don't think it has that much value. But vehicle deliveries, you can see, are growing quite fast, and free cash flow is also growing. But if you see the recent first quarter update, even went higher. Look at this, even amazing, and also good free cash flow. And if we show this in trailing 12 months, which is a better way of looking how it's growing, you see how they are ramping up deliveries and how cash flow is also responding. And if we go to the couple of days ago first quarter, you see that it's even accelerating, and also here. So all these are great things. And again, in the first quarter, they have the core technology slide where they show interesting things. One of the things I like here is Vision 9, they call it a V9 version of the full self-driving. And I think they call it V9 because it's a vision and 9 cameras. They are forgetting about radar, and they discussed this a little bit in the quarterly call. They are using artificial intelligence, and because they have, this is another advantage I think that Tesla has, because they have millions of miles per day driven, and they feed a central system because every car is connected. They can sort of like tweak daily, let's say, their systems. They had to start from zero. Again, they sort of from scratch. I'm going to show you probably a clip if I have time.
With regard to full self-driving beta continues to make great progress. But this is definitely one of the hardest technical problems that exists, that's maybe ever existed. And really, in order to solve it, we basically need to solve a pretty significant part of artificial intelligence, specifically real-world artificial intelligence. And that sort of AI, the neural nets need to be compressed into a fairly small computer, a very efficient computer that we've designed, but nonetheless, a small computer that's using on the order of 70 or 80 watts. So this is, I think, a much harder problem than if you were to use, say, 10,000 computers in a server room or something like that. This has got to fit into a smallish brain. And this, I think, with the elimination of radar, we're finally getting rid of one of the last crutches. Radar was really it was making up for some of the shortfalls of vision, but this is not good. You actually just need vision to work, and when vision works, it works better than the best human. Because it's like having 8 cameras. It's like having eyes in the back of your head, the sides of your head, and 3 eyes at different focal distances looking forward. This is, and processing it at a speed that is superhuman. There's no question in my mind that with a pure vision solution, we can make a car that is dramatically safer than the average person. So, but it is a hard problem because we are actually solving something quite fundamental about artificial intelligence. We basically have to solve real-world vision AI, and we are. So, and key to solving this is also having just a massive data set. So, just having well over 1 million cars on the road that are collecting data from very sort of corner case rare situations. Sort of like so many weird things in the world, like a truck carrying a truck, or a car with a one example is a car, an actual example, a car with a kayak on the roof, where the kayak has a little weight dangling from the front of the kayak in front of the car, and yet the car must ignore this and just look at the road. So it's really quite tricky, but I am highly confident that we will get this done. So
here, look, Model 3 was the best-selling sedan in the world last quarter, and again, the improvements in range. I think that you can say that by now, 400 miles, this is like 600, 700 kilometers, is almost as good as any internal combustion engine in range. So the only problem, let's say, would be to find where to charge it quickly, because if you charge it at your house, it's going to be overnight. But if you go on a trip, you don't want to spend a full day charging your car. Okay. So one thing I want to show you here is in terms of vehicle fuel consumption. And we have here, the yellow is gasoline, this orange is diesel, somewhere here is a plug-in hybrid, and this is battery. Let's say this is empty weight in kilograms. Let's say 2,000 kilograms is something average for a car. In a gasoline car, you use 9 liters of gasoline per 100 kilometers, and this is liters of gas equivalent, because of course when you want to compare with battery driven cars or battery fueled cars, they don't use liters, but they use kilowatts. So as you can see, you use almost 1/4 per 100 kilometers. So if we move to electric vehicles, we will be 4 times more efficient in the world. So we will use less energy, which is good. But if we produce that energy from solar or renewable, it's going to be even better. So this is something I wanted to show, but I'm going to give you a little bit more here. If we see here, the gasoline roughly has 33 kilowatts hour per gallon. So if we assume 33, let's say, kilowatts hours per gallon, that because 1 gallon is 3.8 liters, and I'm going to convert everything into kilometers and liters because I am not in the US. 1 liter of gasoline will have 9 kilowatt hours of potential energy. And I'm saying potential energy because more than half of it is wasted in heat, while in the electric vehicle is much more efficient. So at 9 liters per 100 kilometers, that means for 100 kilometers you will use 81 kilowatt hours for a internal combustion engine, while on an electric vehicle for 100 kilometers, as we showed here in this previous slide, is roughly 2 liters equivalent. So which means 18 kilowatt hours. So if it's 2 liters times 9, it's 18 kilowatt hours. So if you go to the e-tron GT, which is the Audi electric vehicle, it has a tank of 95 kilowatt hours. Tank, between inverted commas. It can drive roughly 440 kilometers in range. So if we do the math, that means 21 kilowatt hours per 100 kilometers. But if we see Tesla, the Model Y only needs 15 kilowatt hours per 100 kilometers. So not only electric vehicles are better more efficient than internal combustion, but Tesla is more efficient, probably 50% more efficient, roughly, or 40% more efficient than their competitors. If you see here, here's the Audi e-tron, and if you make this computation with using 2.5, which is what they're using here, you'll get similar number that I get here. Okay. So past performance. This is what we just saw. Past performance. I think it's a company that is doing the right thing, is going on the right direction in growth, free cash flow, operating margin. All that I like. So for me, it passes past performance. Let's go now to management. In management, you know I like to check capital allocation. I like in capital allocation, I like to see return on invested capital, which is I think a result of how well they are allocating capital. I want to see align with their shareholders, management aligned with shareholders, and compensation also promoting this. Long-term vision, disregard for Wall Street's short-term objectives, stock ownership by insiders, and dividend policy. All of them are interconnected, like dividend policy and capital allocation is connected, long-term vision and disregard for Wall Street is connected. Stock ownership by insiders, of course, will mean alignment with the shareholders, and alignment with shareholders means good capital allocation. So I think everything is connected, but this is a summary of what I try to find. These are the traits I try to find when I analyze management. So one thing I want to show you, they acquired Solar City. Solar City was a company mostly owned by Elon Musk in 2016. There could be some conflict of interest here. No conflict was found, even though some shareholders made a claim and stuff like that. But this is something I sort of don't like, I see why Solar City or all they do is better, I think, under the umbrella of Tesla. Here I want to show you, we also opportunistically strengthen our liquidity further through at-the-market offering of common stock in December 2020. 5 billion. So in the same way that when I want to see buybacks when the price of the stock is cheap, I want to see that they source capital from the market when their stock is expensive. And in this case, this is what they did. For me, the stock is expensive, and this shows, what good capital allocation skills, let's say. There's one thing about capital allocation skills that they discuss about this 1.5 billion that they purchased in Bitcoin, and I'm going to show you a little explanation, a small clip with the explanation of the CFO why they did that. So this is the clip.
So as I noted in our opening remarks, and we've announced previously, so Tesla did invest 1.5 billion into Bitcoin in Q1, and then we subsequently sold a 10% stake in that. We also allow customers to make vehicle deposits and final vehicle purchases using Bitcoin. And so where our Bitcoin story began, maybe just to share a little of the context here, Elon and I were looking for a place to store cash that wasn't being immediately used, try to get some level of return on this, but also preserve liquidity. Particularly as we look forward to the launch of Austin and Berlin and uncertainty that's happening with semiconductors and port capacity, being able to access our cash very quickly is super important to us right now. And, there aren't many traditional opportunities to do this, or at least that we found and in talking to others that we could get good feedback on, particularly with yields being so low and without taking on additional risk or sacrificing liquidity. And Bitcoin seemed at the time, and so far has proven to be a good decision, a good place to place some of our cash that's not immediately being used for daily operations or maybe not needed till the end of the year, and be able to get some return on that. And, I think one of the key points that I want to make about our experiences in the digital currency space is that there's a lot of reasons to be optimistic here. We're certainly watching it very closely at Tesla, watching how the market develops, listening to what our customers are saying. But, thinking about it from a corporate treasury perspective, we've been quite pleased with how much liquidity there is in the Bitcoin market. So our ability to build our first position happened very quickly. When we did the sale later in March, we also were able to execute on that very quickly. And so as we think about kind of global liquidity for the business and risk management, being able to get cash in and out of the markets is something that I think is exceptionally important for us. So we do believe long-term in the value of Bitcoin, so it is our intent to hold what we have long-term and continue to accumulate Bitcoin from transactions from our customers as they purchase vehicles. Specifically with respect to things we may do, there are things that we're constantly discussing. We're not planning to make any announcements here, and we're watching this space closely. So when we're ready to make an announcement on this front, if there's one to come, we'll certainly let you all know.
So as you can see, what the explanations he gives for why they bought Bitcoin are not necessarily long-term oriented in my view. Bitcoin is quite volatile, and if you want to make an investment in Bitcoin, and I don't know how much it's going to be worth next year, so I think he's speculating, and I don't like that. But he must be better than me, because otherwise I would be the Tesla CFO. Okay. And this is from the Form 10K of last year. They talk about performance-based stock options. And these are the performance milestones that they need to meet. They have met all of these except this one. And this one means annualized gross margin greater than 30%. So why I'm showing you this? This is because I want to keep this number in mind when I make my projections in the future. But I also wanted to show you that they have a stock-based compensation, which is based on many milestones that are quite difficult to manipulate. I think, for example, production, completion of this first model production, or the aggregate production of 100,000, or then completion of Model 3 production. So I like this type of milestones. Let's go to the executive compensation. Tesla has no cash bonus, which I like. If you've seen my previous videos, I don't like cash bonuses at the level of executive, because I think that they are a waste of time. They are not, so they agree with me. Apparently they don't like cash bonuses. Generally, they do not provide any perquisites or tax reimbursements to named executives, other than different than they do to all the employees. This is something I like as well. Each named executive officer is also employed at will, so no contracts. If you don't do your job, you leave. Elon Musk earned a salary, but mainly because due to requirements under Californian law, but he has never accepted his salary, which of course is good. But in 2018, he received quite a substantial equity award, but with a quite big also threshold to meet. So as you may know, he met some of those, and he's doing quite well. But I think it's good for the company to have a CEO with this package. I'm going to discuss a little bit in detail further. So here, no such consultants were engaged, which I like. Base salary, which is quite decent, really very low salary for this company. The equity compensation for the CEO in 2012, 5 million shares, which was roughly 5% of Tesla. And I think all of them, or 9 out of 10, have been reached. So he already got paid. But then they make a new one in 2018. And this new one is 20 million shares. He can buy them at 350, which I think this is pre-split. So this would be, it's roughly, after the split is going to be like 60. So it's 12 vesting tranches. Each one is equivalent to 1% of the outstanding shares. So 12 means 12% of the shares outstanding. And for each of these tranches to be able to vest, he will have to, the market capitalization would have to be at a certain level in 50 billion increments. And if you see, they start in 100. So if you multiply 10 times or 12 times 500, is 500 million plus 100, so 700 billion. And this is already achieved. One has already been achieved because of the dramatic meteoric price increase of the stock. But then it has to meet also a second milestone, which is any of these. Either these are 12, as you can see, 1, 2, 3, 16, sorry, 1, 2, 3, 4, 5, 6, 7, 8 revenue and 8 EBITDA. So any of this is met, and then this one is met, and he can vest. So I think he has vested this and this, because this as I said is already achieved. So he has vested 2 of this already. It's a lot of money. If you see here, Elon Musk, they have valued that at 2 billion, which is quite substantial. If you check that in terms of valuation, this is 2% or less, a little bit more than 2% of the valuation today of the company. So it's nothing too much, but it's quite a motivation for I'm not sure whether it's a big motivation for Elon Musk, because he already owns part of the company. So okay, but well, this is what the board of directors is, the way they are motivating him. If you see, the rest is stock awards are quite decent, and also here options are decent for the rest. So I don't think I don't see anything dramatic negative here. It's okay. So I think that return on invested capital, I haven't been able to see yet, because this is a company that is only starting to produce return, let's say. Up to a few months ago, it was all loss, even free cash flow. So it's difficult, but you'll see. I'll give you a few numbers here in a few minutes. But I think capital allocation, they are doing okay. They are doing okay in all of this. I think that for me, management is also past. One thing about management that I always like is to have a shareholder, founder that is so motivated to make this work, not only financially, but because you can see that it's his life, his passion, and everything. So I like that. I like to be to be a partner of a person like this. So let's go to competitive advantages. Let's see. These are the competitive advantages I have identified. Technology and brand, of course. This is the intangible assets. The most important that they have, I think. Let's go quickly on this, and then we'll talk a little bit about technology. Switching cost, I think they have, because once you buy a Tesla and you are into all the, probably you can, if you get the subscription, some of the services via subscription, and you also have the network. So switching to another car is not like switching from your Toyota to your Honda. Here, if you want to change from a Tesla to another one, I think you'll have, for example, if you have installed at your home some charging, you've done some investments in your house to charge, or if you go to another one, you will have to change your patterns of charging, at least for now. I don't know in the future. Probably in the future everything is going to be standard. I don't know. Economies of scale, of course, they are reaching now, and that's why you see that they are improving their numbers. But it's not a great advantage if you compare it with other manufacturers. So all of them have economies of scale. In any case, technology and brand, I think, is a great asset that they have. I discussed a little bit earlier, and if you see, for me, the technology they have in battery and powertrain, especially in battery, in the software, and in self-driving development, I think they are 8, 9, 10, who knows, years ahead. And as I said, they are widening, because they are focusing. They are just focused on this. They don't have to focus on whether they need to make a better internal combustion or whatever. They are focused on battery, powertrain. They are focused on gigawatts. This is one of the advantages I see. The other companies don't have, not only they don't have the talent in terms of being able to innovate in battery, because battery needs lots of innovation in the future. The other companies will be able to, of course, make electric vehicles, but they will not be able to make electric vehicles of the quality, let's say, of the efficiency, because the battery is where lots of an innovation in terms of costs and in terms of range they are mostly in the battery. I mean, the electric motor is, everyone can make an electric motor. I don't think there's much in an electric motor that you can improve. They already have 90-something% efficiency. So you'll see that battery and powertrain, but battery especially, is where they have the advantage. And also software, the way that they are working to achieve self-driving, I think is going to be a few years ahead than the competition. So they have great advantages here. So competitive advantages for me is a tick, even though if you compare with the competitive advantages of other companies like technology companies that I have discussed in the past, a few of the companies like Amazon, Google, even Facebook, because those have network effects, and network effects for me are the highest of the competitive advantages. Technology is the second highest, in my view, but Tesla, I mean, it is there. So let's go to financial position. We're not going to spend too much time. They have very little debt, 9 and 2, and they have more cash than debt, so they are in good financial position. So a tick again, financial position. So all quality measures from my perspective are met for Tesla. I am now able to go and check whether the price is the right price. So let's go to projections first. If I see the outlook that they show, they have the 50% annual growth in vehicle deliveries. They say that they have sufficient liquidity to fund the roadmap, so free cash flow positive. Profit, they expect operating margin to improve as they increase in the capacity. They are building a gigafactory in Berlin, gigafactory in Austin, Texas, and I think they will have to build 1 gigafactory a year if they want to achieve the growth they want, or even 2 a year. I'm going to discuss this in a bit more detail in a minute. This something also to keep in mind. Musk in 2014 said, if you take 2013 revenue, which was 6 billion, and we are able to maintain a 30% growth, so he thinks that probably now we're in 2021, I think that he still believes 30% growth in revenue per year. He was talking about 10% profitability, which is net income margin of 10%, which is quite high, but this is what Musk has in mind. So this is something to keep in mind for my projections, okay? Another thing they talk about in the 2020 10K is that they're going to use 4.5 to 6 billion in capital expenditures, and you'll see in my projections I'm using this as a benchmark. Okay, so this is the price drop must be contemplated in projections, because if you see, I do not think we lack the desire for our product, but we do lack affordability. This was a few weeks ago. So affordability means they have to make cars cheaper. And so this is something I'm going to take into account in my projections. Okay, so now let me show you my revenue projections. What I do is I try to project first the business, the market itself, in terms of global electric vehicle sales in number of cars. So I'm starting here. What I do is I go to this report, the Global Electric Vehicle Outlook in 2020 from the International Energy Agency, full of information. So this is the past. 2019, 7.2 million cars in the road. This is the fleet or the stocks, car stocks, electric vehicles. So here you have 7.2 million. So 7.2 million, electric sales is 2.1, and so 2.6% of total sales are electric vehicles. I get some information from other places for 2020, but then the projections, and in the projections I'm using the same report. If you see, this is what I'm going to concentrate. In terms of the global stock, so I mean the fleet, the number of vehicles in the streets, they have a projection for this stated policies scenario. They have two scenarios, the stated policies and the sustainable development. This is much more aggressive. This is if every politician and company and customer in the world say, okay, let's improve this sustainability problem that we have, which I think is not going to happen. And this is if the situation, if we comply with what the policies that we already have, like Paris and all that. So this is a more realistic one for me. So this is the one I'm going to follow in this outlook. 50 million cars is going to be the stock in 2025 and 140 million in 2030. In sales, which is the more important for me because sales is what's going to drive my projections. 2025, they say they're going to sell 14 million, and here they are going to sell 25 million vehicles in 2030. This is what I'm going to use. As you see, this is what I'm using: 14 million in 25, 25 million in 30 global electric vehicle sales in numbers. And if you see here, this is the percentage in sales is 10% of all the sales of all the cars, and it's going to be 16% here. But now comes, what do I do with this? I'm going to assume that Tesla, which has been delivering this number of cars per year, is going to keep growing 50% in 2021, as they say, but I'm going to ramp this growth down to 10% in the next decade. I don't know, this could be too pessimistic, this could be too optimistic, but this is what I'm going to assume. And this means that in 2030, they're going to sell 7.4 million cars. If you see this clip from Elon Musk, he thinks that he can be able to sell 20 million cars in 2030. This is what he says. Listen to him.
I mean, long term, we want to try to replace about at least 1% of the total vehicle fleet on Earth, which is about 2 billion vehicles. So long term, we want to try to make about 20 million vehicles a year.
As you can see, Elon Musk is quite bullish on the growth of deliveries and the production. Here I'm going to share with you Credit Suisse analysis, and this is the way they think is going to happen, sales, and they even split between each model in million units. So they are planning 5 million units in 2030, and as you remember, my projection doing this 50 and 10 is 7.5. So I am more aggressive than Credit Suisse here. And I am also going to make energy, generation and storage, and service and others. I'm going to use 60% and 70% for each of these respectively, and ramping to 20% and 25%. So this is going to be the growth I am planning to project for this service and others, and energy generation and storage. Service and others could be software, the software that they sell, self-driving and all that. It's quite the big growth, sustained for quite a long time, but I'm going to be very, very bullish, let's say. If you see, my sales are going to be 440, out of which 105 plus 70, so 40% roughly is going to come from these two segments. So 60% is going to be automotive. And the way I reach this amount, 261, is because this is the number of deliveries, but I am using the average price, simple average price of the cars, and I know that they have been coming down, and I showed you that in the when we review past performance. I am going to assume that they keep going down, but not as dramatically as before, because this average price is going down very fast because they are transferring the production from one expensive car to less expensive cars. But in the future, they will keep producing, let's say, in mass. So all this price reduction is going to come from innovation. But they are planning to build a car of $25,000, they said, price. So the cost would be even lower. But so what I'm saying is, okay, let's say that they reach that 25, and in the mix, because they have other cars more expensive and all that, let's say 35. So if I do this, I interpolate between the 51 now and the 35 in 10 years from now. This is what I'm going to have in terms of average price, and that will give me, together with the number of vehicles that they produce, that will give me the automotive sales. So together with the other two businesses, this is the sales I'll get. And if I show you Credit Suisse projections, they go much more in detail, they reach 240 billion in sales. But if you see service and other, and energy, which are this it's only 50 billion. Compare that with my 170 billion. And this is 430, in my case, full revenue, and in their case, 240. So I am aggressive in terms of sales. And what I'm doing is trying to keep Tesla market share at the 20, 30 at the most. I think, probably it's too aggressive, but they have been, 29% this year. So it could be possible, especially because they have an advantage, I think, versus the others. So let's give them the benefit of the doubt. And if I use the number that Elon Musk is aiming, it would have to be, instead of 720 million. So I think that I am Elon Musk 20 million would mean, if this is true, that we sell 25 million in 2030, he will have 80% of the market, roughly, which is, I wouldn't bet any money on that. Before we move on, let me show you one thing about projections. In the Battery Day of 2019, they came out with this presentation. And what they are saying here is that we need, as society, let's say, 10 terawatt hours of production per year during 15 years, which is what will require to change the whole fleet, because a car lasts roughly 15 years. So if you have to produce 10 terawatt hours in electric per year, you will have to do it 15 years in order to have the whole fleet electric. So this is just to give you an idea. We need 15 years. If today we start producing 10 terawatt hour in batteries per year, we need 15 years to go 100% electric. So it's impossible, really. It's impossible, because today we are only producing 0.1 terawatt. So that means that we need 100 times so this is what they say here. We need 100 times of growth. And this 100 times of growth is only to achieve full electric vehicles in 15 years. Of course, it's not in 1 year, it's impossible. But even to achieve it in 15 years, we need 100 times the capacity that we have today. So this is just to give you an idea of the mountain that we have to climb, let's say, to become a society based on electric vehicles transportation for 100% of our fleet. So when I make these projections, if you see, and this is, of course, I'm using the projections of someone that did the study I showed. They are saying that we will achieve 16% of sales and 7% of the fleet. So with these numbers, we will be at 7% of the fleet by 2030. Let's go to this. If we go this route, let's assume we have 100 times the capacity. So let's say that tomorrow we have 10 terawatts hour of production tomorrow. In 10 years, which is 66% of 15 years, which is what will take to change the whole fleet in the world. In 10 years, if we go at 10 terawatt hours per year, we will only reach 66%. So if we are reaching 7%, that means that we are assuming, in the assumption embedded in that is that we're going to have one terawatt hour. So 1/10 of the 66 is 6.6. So it's roughly the 7% that we're reaching. So that means that 1 terawatt is 10 times this. So if tomorrow we go 10 times what we are producing today, we will reach this 7%. So even this 7% is not an easy thing to reach. So this is, I wanted to show you this to give you sort of like an idea of how, I mean, when people talks about we're going to go electric in a couple of years or in one decade, it's almost, if you see it from the perspective of the capacity in batteries production that we need, you realize how difficult even reaching this level that I am projecting here. So this is my revenues projections, and so this line here, these numbers here, is what I'm going to use in my model. So this is my model. I have revenue here, which is the number I just showed you. It's growing 32, 40, 40, blah, 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 10. So in essence, it's growing, look, from 31 to 4, so 10 times roughly, 10 times in 10 years, meaning around 25% growth per year on average. In terms of gross profit, I come with a 21 and end up with a 30, and this 30 I'm taking from what I mentioned you before. This is one of the 30% is one of the goals for management. So I think that they think that they can achieve it. So I'm going to give them the benefit of the doubt, and in 10 years to achieve this. They want to improve margin from 6%, and I'm going to say, okay, let's say that they get to 10%. Elon Musk, as you remember, said that he believed on a 10% profitability number, but this is net income. For me, net income is going to be much smaller because after taxes and interests, 10% is what I'm going to use. Let me show you here quickly a compilation of different ratios for BMW, Volkswagen, General Motors, and Ford, which are, of course, competition, Tesla, and Alphabet. Because many people say that Tesla is a technology company and should be valued as a technology company. And I think that they are a technology company because they need huge amount of innovation and technology to do what they want to do. But they are not a technology company in the sense that they don't get the same returns on investing capital. They need copious amount of investment to keep the ball rolling. So they are more, I mean, in terms of valuation, at least they should be valued closer to the other car manufacturers than to, Google. And I want to show you here, for example, Google return on invested capital, 14%. All the car manufacturers have a return on invested capital of 1.9%. And Tesla, negative, but let's say that they reach 4, which is what they reached in 2020. So I think that they are closer in that aspect to another car manufacturer than to Alphabet. And let's say that they can sell some software as a self-driving service by subscription, so they can have some traits of a technology company, but it's going to be minimal, I think. BMW net operating margin 8%, quite decent, average, but 4% in 2020. Volkswagen 4%, 8% 5-year average, 4% in 2020. 5% with General Motors, negative Ford. And here we have the 6% that we discussed. But if you see Alphabet, operating margin 24%. So this 10% I think is quite reasonable. Then I get with depreciation and amortization, which what I do with depreciation and amortization is I try to keep it similar to before in terms of cost of goods sold. So the proportion of cost of goods sold that is depreciation and amortization. Is going to be similar to the past, but it's going to keep growing because I think that they need lots of investment, and because these are long-term, amortization investments, like 20 years for plants and all that. I think that all the investment that they have been doing in the past will keep adding to this number here. And the EBITDA, what I do is I assume 15 times EBITDA, and with 15 times in 2030, I compute the market capitalization. And with market capitalization and this amount of weighted average stocks outstanding, I can get the price. First I want to discuss something about this 15. When we saw here all these comparisons, if you see enterprise value to EBITDA for a technology company is 17. And I'm using 15 for Tesla, and as I said, Tesla is not a fully technology. I mean, it's not in the same league. So I'm being quite optimistic. If you see, for example, all the other car manufacturers have an enterprise value to EBITDA of 2, 5. Well, Ford has a high one, and 5. So much smaller. I am giving a much higher than the other companies, that the other manufacturers, because the growth that Tesla is going to have is going to be much higher than the rest, and I am projecting that. Let's go to my other part, which is the cash flow, which is the other half of my valuation, which is based on free cash flow. So what I do is I project operating cash flow using this growth. Then I use 10% as capital expenditures to revenue. And so because I have the revenues, I have the capital expenditures. If you see here, 6 billion. And as I showed you a few slides ago, they are planning something between 4 and 6 billion. So in capital expenditures, so this fits management projection. Once I have capital expenditures and operating cash flow, I can get free cash flow. And again, I want to check that free cash flow it's growing from 4 to 43, 10 times in 9 years. That's another 25% roughly per year, which is huge. But revenues are also growing that fast, and the company is going to be more efficient in terms of free cash flow generation. So I think it could be okay. And also, if you see free cash flow versus EBITDA, it's going to keep at similar levels than we've seen in the past. So with that and 24, I'm using 24 as a enterprise value to free cash flow. In year 30, I can get this as the capitalization that the company will have in year 30. I want to show you what does 24 mean. If you, let's step on 2030. In 2030, I'm going to pay 24 times free cash flow for the company. What that means is, if we have a company of 100 in free cash flow and make it grow this way, you see 15, 14, 13, 13, up to 8. We make this grow that way, and then we make it grow at 3% in perpetuity, so from year 10 over. So this would be 2040. And then I calculate all this to present value at a 10.9%, which is the weighted average cost of capital that I am using for in this example. All that means that the enterprise value of this, let's say, stream of cash flow will be 2.4 billion, or 2.4, let's say, times 24 times this 100. So this is 24 times, free cash flow to enterprise value is 24 times. This when you use 24 to value based on free cash flow, this is what you are assuming, really. Something like this. Of course, you can change things here that you can still get, you can increase this and increase this, whatever, but this is one assumption, one possible assumption. And it sort of makes sense because we're coming from 64, blah, 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 low, to 19, then it goes to 15, 14, 13, and then I go to 3. Another thing I want to show you, this free cash flow, I'm going to check what's happening with Credit Suisse. Free cash flow for Credit Suisse is going to be 3 and then 30, 10 times as well. But they will reach 30, which is a bit smaller than my 43. But I am in the ballpark, It's not that I want to copy what they are doing. In fact, I think that they are doing a few things that I don't agree. But it's good to have some other perspective, from someone else to check. So now what I'm going to do is the 10-year target price is going to be the market cap based on EBITDA, which is 1.3 trillion, which is the one that I got here, 1.302. Market cap based on my EBITDA times 15, 132, and then this one, the 1039, which is the one I've just arrived with a free cash flow. Average 1171, diluted weighted average stocks 112 roughly. So this is my 979 is going to be my target price. Okay, so I just showed you my projections. Let's now go to my calculation of intrinsic value. Let me first give you a few comments. This Pierre Ferragut is New Street Research analyst, and he is a bull, really a bull for Tesla. He doesn't see credible new competition on the horizon, which will help Tesla maintain growth and leading profit margins. While other automakers cannot produce electric vehicles at comparable prices to equivalent ICE, so internal combustion engine, Tesla's Model 3 at 15% lower price relative to premium sedans. So he's bull, and what I want to show you is how difficult it is to value Tesla, that people that know what they're doing, they have been valuing companies and analyzing companies for years, they come to different conclusions, and also I come to different conclusions from them to them. So I want to show you a little bit about this. So I want to show you a few examples. For example, this what he says is that it needs this is the mathematics he's doing. In 2026 he thinks it's going to be 100 billion in sales. And you remember my projections. In 2026, I was planning, my projections are 200, so half, so double what this analyst is projecting 100, and I am projecting 200. But even with 100 in sales, he thinks that $16 in earnings per share by 2026. And if you see, in 2026, my projection of earnings per share with this, which is double the level of revenue, is 7 only. So if I reduce this by half, it's going to be 3. I don't know how he comes with 100 billion to 16. Of course, he is very, 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 very optimistic about the margins, that there's no other way. Okay, this is one thing. And then if you put 50 times, which is Amazon, so he's saying that it should be valued the same way as Amazon, and I explained that shouldn't be the case, because even though there's lots of technology in Tesla, it's not a technology company. So he's saying that it should be worth blah, 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 whatever, you get a 20% return. So this is bull. And I want to show you here a compilation. You see that they reach from this guy, Gordon Johnson, 67 target price. He's completely bare. And you have Argus or even Wedbush at 1,000, the price. This is in terms of price. So it's all over the place. It's very hard to value this company, I think. And it depends on couple of things that you tweak, and you can get tremendous value. I mean, like 1,000. So, for example, if you see, let's see, Patrick Hamel, he thinks that the automotive is going to be worth 2/7 of this, 200 roughly, and 500 in price is software and all that. And I think that here, yes, you can say that software is valuable, but the problem is that the pocket of the consumer, like you and me, we have a budget. And this is, let's say, X% goes for transportation, between insurance, the car, gasoline. So even if they offer me a software that is self-driving or whatever, I mean, and I have to pay the same price for a car, but then they ask me to subscribe for whatever amount to have other services. I don't know, probably it's hard, to Patrick Hamel doesn't think that he thinks that we are going to be able to put more money into our budget related to car expenses, and because we're going to have this service. I don't know. It's an interesting question. And then you have here, for example, Morningstar with a 349, and they are saying that if Musk is right about the 20 million units by the late 2030s, they think that it's worth 1.5 thousand. So the 3.5 goes to 1,500. So higher than everyone. Only if this happens, which of course is a big if. And the Credit Suisse has an 800 target price. And I have it here. Let me show you. They have this is the model, this is the sort of the base case. 5 million, I showed you a few things like the 5 million cars, 240 billion in sales. They are using 25% gross margin. And then if you subtract this 6%, that gives you 19% is the profit margin. And remember, that 19% is comparable to this 10% I have here. So they are less aggressive in sales, but they are double as aggressive here. And then they keep being aggressive in here, because the net income that they reach is 35 billion in 2030. And if you see my net income here, my net income is 23. So my net income is even smaller with double the revenue than they have. So in order for them to reach here, and then they multiply by 20 and they get this target price of 614. 35 represents 15% of 240. So they are assuming that they will have a 15% margin, which I think is not possible. I think it's too high. Not even Musk thinks that is possible, because he was talking about net margin of 10%. Okay. And then what they do is they go to Bull and Uber Bull and Bear and Uber Bear. They give some probabilities to each of these scenarios, and they get 800 price. So this is to give you an idea of how difficult it is to value Tesla. And this is my shot at valuing Tesla. So if I have the price, current price is 729, my target price is 979, 10 years, I calculate the IRR of this, plus the yield, the yield of free cash flow, which is going to be very small, and I get this IRR 3.6. Of course, if you are happy with 3.6, you can invest in Tesla, but I think that the risks that we have in investing in Tesla require at least 10%. So I do here a sensitivity scenario. So if I pay 7.29, which is the price of today, I get the 3.64 here. But then if I go to, let's say I pay 401, I go over 10, which would be my goal. And for Tesla, I would invest only at 11, 12%, a little bit more, because it's more uncertainty in my view. So for me, this is the fair value of Tesla, 401, precisely 401. So, and this is the end. So that's my shot at valuing Tesla. I hope you enjoyed it. I hope you found it informative, and I hope you learned something from it. And if you have any comments, I would love to hear from you. Any comments on things that you probably would do differently, or you want to highlight. So please comment. And also, if you like the video, please give it a like. If you want to subscribe to the channel as well. I'm going to do one valuation every 2 weeks, I think, because as you see, it takes lots of time. I go quite deep. Probably I'm wrong, but at least I'm doing the best of my ability. Tesla is a company that I really like, but probably I like it from a consumer point of view. I would love to buy a car, but I wouldn't invest in Tesla at this price. I think there's others opportunities there that I prefer. But well, this is my shot at it. I hope you liked it, and see you in 2 weeks. Bye bye.